Good evening, the erudite speakers for the day, Venkat Kali Prasad Malapaka sir, and also Ganesh sir, and the dear members. The very encouraging number of registrations for the day goes to show that how important the topic is. I, Pannaraj, Vice Chairman of SIRC, is here to welcome you all. And today, both the speakers are from Hyderabad. Either chairman or secretary, both from Hyderabad, should have been here, but they are pre-engaged or preoccupied with some other assignment of the institute itself. So I am given the job of introducing the speakers and the welcome you. It is my pleasure. The topic for the day is CARO 2020 Provisions and Procedures. It is very, very vital because the overall compliance level is yet to be increased, and the quality of compliance also is needs to improve further. That is the opinion of the experts. So, and in these backgrounds, especially for the small and medium practitioners who are having very less number of company audits and would not be able to concentrate much time on this, it is very, very vital topic for all of us to revisit the provisions of CARO 2020 as well as the procedural aspect. It is very vital that the procedural aspects also are covered here. So I request the members to make best advantage of the today's erudite speakers presentations, and this is very, very vital for the compliances also. With this background, and also I thank the chairman and the secretary for giving me this opportunity to be here today. I take the pleasure of introducing the speakers for you. I introduce both the speakers. Both the speakers will be taking out at least 3 hours of sessions. That is, it is 5 now. It goes on up to 8 p.m. At the end of the session, there would be a question-answer session. So I take the pleasure of introducing the speakers. CA Venkata Kali Prasad Malapaka is an FCA, and he passed his the examination of CA Intermediate in 1974 and final in 77 May, both in first attempt, and qualified as a chartered accountant from Hyderabad, and he is in practice ever since in the areas of audits, direct and indirect taxes, corporate law matters, financial management, insurance consultancy, etc. He has a passion for writing and teaching both. He has been teaching advanced accounting, income tax, and auditing to CA final IPCC students at Hyderabad, Visakhapatnam branches of ICAI, apart from the ICSI, ICAI at Hyderabad. Addressed the students of several colleges in Hyderabad and elsewhere on various topics. Also addressed many PSU officers on different topics such as accounting standards to officers of LIC of India, letters of credit as a means of working capital management to officers of Bharat Electronic Limited, inventory management to the officers of Fertilizer Corporation of India, Ramagundam. He has authored books on standards on auditing, accounting standards, company audit, and recently authored a book on corporate social responsibility for the Institute of Chartered Accountants of India. With this brief profile, I very warmly welcome you, Venkat Kali Prasad sir, for this evening's program. Now I take the pleasure of introducing Ganesh sir. Before that, Monica, there is some disturbance.
Sorry,
Monica,
yes,
there is some. You mute your this one.
Sorry, sir.
The speaker. And I take the pleasure of introducing Ganesh sir also. G. Ganesh is a fellow member of the institute and graduated in commerce from Badukia College of Commerce, Osmania University, and also graduated in law from Osmania University. He holds post-qualification diploma in Information Systems Audit and completed the valuation course of ICAI. A fellow member of the Institute of Chartered Accountants with 20 years of experience in practice of audit and assurance services, former partner in Shekhar & Co. Chartered Accountants, Secunderabad, personally continued his practice as a proprietor. Prior to joining practice, he was in industry for over 15 years. Regularly has been addressing seminars on corporate laws and auditing at various branches of ICAI. With this brief introduction, I very warmly welcome Ganesh sir for this session. Very warm welcome, sir. I also welcome all the members for the session and wish you all a very happy and great learning for today on the topic of CARO 2020 provisions and procedures. Over to you, Venkatakrishna sir, Kali Prasad sir.
Vice Chairman Pannadas Garu, it's been very nice of you to nice words about us. And it's our privilege that we could address the members of the SIRC level. So we have decided that Ganesh will give you the provisions and their impact.
And I will cover the procedures to be adopted to comply with the provisions of CARO 2020. So it is but natural that Mr. Ganesh will start with the provisions.
Comply with the procedures to be adopted to provisions of CARO 2020. Ganesh will start. Over to Ganesh.
Good evening, members. At the outset, I thank the Managing Committee of SIRC for giving the opportunity. Now, in my opinion, we are moving towards a half centenary of additional reporting under CARO, under the Companies Act. It started off in 1975 as CARO, took various forms and various transitions, and we have reached CARO 2020. So let us go ahead. The powers and duties of auditors have been laid down under Section 143 of the Companies Act 2013, read with the Companies Auditors Report 2014. Section 143, among the other things, talk about the auditors reporting requirements. And the CARO 2020 requirements was originally to start from 2020, but it was postponed twice due to the thanks to the pandemic. Now it is applicable for accounting period starting 1/4/2021. That it is the financial year 21-22 for which it is applicable. This order has been given by the central government under Section 143(11). Under 143, there are some more additional requirements to be reported that continues. This order, this is supplemental to the requirements under Section 143. So these are the abbreviations used in various slides. It is for your reference. Now let us talk about the exemptions. It is exempt for a banking company, insurance company, Section 8 company, one-person company, small company. Small company as defined under Section 2, subsection 85 of Companies Act 2013. It is applicable to private companies unless they are exempt as a small company or their borrowing powers and turnover are below the threshold limit. So let us see when it is applicable to private limited companies. For private limited companies, if the reserves and surplus and paid up capital exceed 1 crore and there is a borrowing from any financial institution of rupees 1 crore or more at any point of time. So it is not the balance sheet date, it is the borrowings at any point of time that is the trigger for application of CARO, and the turnover of 10 crores. But there is a controversy. The small companies applicability for small companies is not there. So the small company has been, definition has been changed from 1/4/21 in the Finance Act at the time of introduction of the budget by the Finance Minister. A small company is a company which has a paid up capital of 2 crores and a turnover of 20 crores. So it is applicable to a small company if the paid up capital is 2 crores and turnover of 20 crores along with a borrowing exposure, financial institution exposure of 1 crore or more. So where it is applicable? It is applicable to all public limited companies, government companies, foreign companies which are required to maintain books of accounts, the branches of a company which are independently audited by the branch auditors, the project and liaison offices situated abroad. So the CARO 2020 requires to report on each and every matter specified therein as applicable to the company. This does not limit the responsibility of the auditors. This is a supplemental reporting requirement as it goes with the internal control over financial reporting. And the reporting, the supplemental reporting as per the CAG guidelines are supplemental to this order. So we have, in case of a government company, one has to report on the standard report under section auditing standard 700 and standard of auditing 700, the CARO report, the report on internal controls of financial reporting, and supplemental reports as per the CAG guidelines. CARO reporting requirements is the status as occurred during the accounting year and whole of the accounting year and not as on balance sheet date. So it should be observed that the various reporting requirements talk about the status during the year, the compliance during the year and not as at the balance sheet date. So the compliance should be the various provisions of the order, the compliances of the Companies Act should be taken throughout the year and not as on balance sheet date. So seeing the compliance requirements, the reporting requirements, we should plan well in advance, communicate with the auditee about the documentation required and the management compliances. So all said and done, we should be careful with say 230 audit documentation, and 230 speaks of audit information and our standards of quality control over reporting SQC 1. So we have to maintain proper documentation based on materiality under SA 320. These two go together. So any rationale, any qualified remark or any non-qualified or acceptance of the documentation should speak itself because it should be subject to peer review at any stage. Better we do the documentation at the commencement of the audit.
So that's a good introduction. About the provisions and the applicability, etc. Now is the time where we will be starting afresh because yesterday was the end of the longest session of audit we had in our lifetime. So we hope we'll not be having so much of a time hereafter. So the compliances have got to be kept in mind. And most importantly, the compliance with SQC 1, because the institute is spreading its wings very fast and almost every firm would be subjected to peer review in the days to come. Therefore, all the auditors, irrespective of the size, big or small or medium or by whatever size it is, they have to comply with the provisions of law and do a proper documentation, work properly, and be an acceptable professional auditor. So when it comes to CARO, we have to plan for CARO because we are going to commence the audits very shortly. I don't know if it is immediately after the bank audits. We'll be starting with the bank audit, the audits of companies. So the preliminary things would be, we should start working on that right from now. Immediately issue a letter of engagement, because there is still time. Issue the letter of engagement stating out very clearly what are their objectives, how the audit is going to be. Then maybe try to arrange for the management representation level at the time of commencement of the audit. These things can be done even before you actually commence the audit. It is not that the moment you get a letter of appointment, you go there and start watching and other things. There are so many things to be done. At the same time, you should also plan for working under CARO. So for the purpose of CARO, there will not be any separate letter of appointment, nor any other resolution, because if CARO is applicable to your company, you have to carry out audit under CARO also. Therefore, there will not be any separate resolution passed appointing you to audit under CARO. There will not be any separate letter of appointment. But we as auditors should document, should analyze if CARO is applicable to the company. And if it is so, we should apply our mind and then get the letter of appointment, get the letter of engagement ready. In the letter of engagement, we should also write very clearly that audit will have to be carried out under CARO, stating reasons very clearly as to why it is to be applicable. So there is no separate letter of engagement given only for the purpose of CARO. It gets embedded into the normal letter of engagement which we give to the company as such. And when we come to CARO 2020, now we are going to do the first audit under CARO 2020, because as my colleague was saying, it is applicable for all the financial years commencing from 1st April 21. So this year is going to be the first year for implementing CARO for the new set of provisions. So the responsibility is larger. In old CARO 2016, we had only 14 clauses, and now we have got 21. So it is around 1/3 more than what we had earlier. And the compliance also is much wider. So to start with, you make out very clearly as to the provisions under which CARO is applicable to the company. Whether it is a private limited company, being a holding company or subsidiary company of another company, or the turnover limits, or whatever is the criteria, you have got to make a clear document as to why CARO is applicable to the particular company. And if it is applicable, you make out your letter of engagement saying very clearly what should be the requirements, and also mention that we'll be carrying out an audit under CARO and we require so and so, so and so, so and so. Similarly, when you are asking for a management representation, you insist upon them about what representations you would be requiring them to give you from time to time. And in this, there is a special provision that each clause has to be addressed and it has to be answered. Simply, earlier it was a procedure where they said that clauses so and so to so and so are not applicable. That will not be acceptable. That will not be proper. No, it should say that the company has maintained cost records, or the company has not maintained cost records, or there is no provision of company for the company to maintain cost records. Don't simply say that the provision does not apply. Clause number so and so does not apply. That will not be proper. Each clause has to be addressed. Each clause you got to give a proper, whether it is applicable or not, and if it is applicable, then whether the conditions required have been fulfilled or not. So the report under CARO for now will be more comprehensive than the report under the earlier ones. So to start with, I would advise issue a questionnaire to the company to gather information to comply with the CARO. There are clauses. For each clause, you make out a separate questionnaire for them and you ask them to answer that. That will give you a lot of information that will facilitate the company to give the related information together with the audit information. Anyway, we will be asking them for audit information like their trial balances, stock sheets, bank reconciliations, bank accounts, so on and so forth. Along with that, they'll also be giving you this information, which will facilitate them to furnish information to you that will also be easy for you to carry out your audit. Built into the audit program, when you draw an audit program, build into the audit program the procedures to be adopted for compliance under CARO. So what procedure got to be done? So you enhance your audit program. You revisit the clauses and see wherever possible, you edit it and improve and increase the number of clauses in your audit program. And as a part of internal control of the audit, the quality of audit, a different team may be formed to look into the CARO requirements for a better compliance. Somebody would check whether the records have been maintained or not. Let some other team look into the CARO aspect. Though not stated anywhere, it is better for you to have a different team. So over to Ganesh for the next provision.
Thank you very much, Mr. Varun.
Ganesh sir, we are not able to hear you, sir. Ganesh sir? Ganesh sir, can you hear me? We are not able to hear you, sir.
Sorry.
Now, yes.
The changes in CARO are in tandem with the changes in Schedule 3. Having seen the requirements of Schedule 3, our reporting under CARO would become easier. So the requirement is whether the company is maintaining proper records showing full particulars, including quantitative details, situation of plant, property, and equipment. The quantitative details and situation are required so that the verification is made easier and identification of property, the assets is easier. The record should be maintained either in manual form or electronic form as it is permitted. The non-maintenance of PP records should be registered fully updated requires a qualification. Merely telling that it is in the process of being updated or partially updated does not suffice. This practice should be foregone immediately. I give over the right side the details of the standards, applicable standards, and standards on auditing for your easy reference. For example, AS10 deals with PPE. Similarly, in AS 16, AS 19 deals with deals with leases, then assets, non-current assets, held for sale, right to use of assets, leasehold property, etc. In addition to reporting on PPE, a new reporting requirement is intangible assets. What is an intangible asset is defined under AS 26 and in AS 38. So we should see whether the asset is an intangible asset. Generally, the intangible assets are like patents, trademarks, franchises, licenses, which give a income over a period of time. Software license is also an asset, but an operating system license without which the system will not work. For example, a machinery will have an operating system license, which is not a intangible asset. It's a part of plant and machinery. We should understand and it should be depreciated along with the plant and machinery. It is not a intangible. It is an embedded system requirement which without which this plant and machinery will not work. Physical verification. It is mandatory irrespective of the size and nature of business. The physical assets are physically verified by the management, and there's a process of identification and of the existence of assets. So it should be done at reasonable intervals, and the materiality level has been fixed by the ACMA. We don't have any discretion. They have told if there is a variation of 10%, and it has been adjusted, we have to report. And the periodicity of verification can be different for each one. Depending on the nature and size of the business, it could be 1 year to 3 years, but the maximum threshold is also has been fixed by the Act. So most of the job has been done easier. The materiality level, we need not go to SCA 320. It is already fixed by the Act. The physical verification can be done by an external party, keeping the nature of the assets. SCA 620. We should see the compliance with the SCA 620. We should gather sufficient audit evidence that the verification has been done. They are muted.
Sir, we
Okay.
are able to hear you.
Then title of ownership. So in case of immovable properties, the definition is whether the immovable properties are held in the name of the company auditee, and it has, if it is not held in the name, we should provide the details. This reporting requirement was there in the CARO 60. It continues. The format of reporting has been prescribed. We should take care if there is a change in constitution, name, or ownership due to merger, demerger, amalgamation. It should be, the property should be mutated in the name of the new entity. In case of mortgage assets, we should get a confirmation from the entity that the assets are mortgaged, and we can even check with the government website where if a charge has been created. The MCA website will show the charge creation. Revaluation. Revaluation has been there. It always been followed by many entities. If there is a revaluation, we should report there has been a revaluation, and if there is an increase or decrease in the carrying value of more than 10%, again the materiality level has been fixed, and the event should have been revaluations during the year. So if in the previous years there had been a revaluation, we need not report. It is only the revaluation occurs during the year, we should tell there has been a revaluation and there has been a change in the value of assets. So in case of revaluation, we should clearly note that when there is a transition to Ind AS, there is a fair value or fair valuation, remeasurements to change in exchange rates, ROU under India right to use modification under Ind AS 116. In these cases, this is not a revaluation, it is merely a compliance with accounting standards. So a revaluation by per se, it is a revaluation only, it is a reporting is required. So we should understand the revaluation should be done by a restored value as prescribed in section 247 of the Companies Act, and we should properly document. See, everywhere I have been reiterating the fact that the documentation and materiality plays a key role. Unless it is not complied, we will be in problem. Then the one more additional requirement of the clause 1 is Benami transactions. Benami transactions is, this goes with one more clause of Tax Act, Consolidated, is clause 8. Clause 9, I think. Clause 9. There is a proceeding issue at the transaction, the nature of transactions, and what are the reported here.
Sir, can you hear me? Sir, there is an echo. Yeah, now you can start, sir.
Over to Kalikas.
So there is a vast diversification requirements in the matter of plant, property, and equipment. So new avenues have been thrown open as they have bifurcated between tangible and intangible assets. And thank God they have not included the intellectual properties also into this. Then they have talked about the Benami transactions. They have talked about maintaining of register. They have talked about revaluation of assets, about verification of assets. So a new dimension has been given altogether for the plant property and equipment. First is examine the asset register. Every entity is required to maintain an asset register. And satisfy that the quantitative details and situation are stated in the register. And normally, it will not be up to date. Insist that the register will be updated before you complete the audit. Don't simply go on record and say that it is not maintained properly. Ask them to do that and say that they are maintained properly. Then assets discarded or assets retired and or held for sale have to be mentioned separately as such, because the applicable accounting standard for these assets is separate. They are covered by 105. Assets held for sale or assets discarded or retired. So there should be a clear classification of those assets which have been discarded or they have been held for sale. So this is as far as the maintenance of assets have been concerned. So extra cautious thing should be the register of investments, the register of intangible assets, then the bifurcation of assets for sale. These are the extra precautions you should take while verifying the asset register. Then when you are verifying, ensuring that the locations are correctly entered in the register. This happens mostly because of, say, vehicles or furniture. They could have opened a new branch. Some furniture of the old branch could have been shifted to the new branch. We find this happening in most cases of the branches of banks, that they move some of the equipment of an old branch to the new branch, and maybe this they will provide with a new equipment. So there could be a change, and the location, if there is any such change, that should be properly recorded. Ensure that the locations are correctly entered in the register. So verification of assets, which you do in the normal course of an audit, should be done along with the asset register. See that the present location of the asset gets recorded normally in the asset register. Simply saying that the register could not be verified. So don't say that because of COVID I could not verify the asset register. Nowadays the registers can be maintained electronically. You can always have access to that. Saying that I could not verify the asset register because of COVID will not hold good. Or saying that the register is incomplete, that may not be a acceptable excuse. So don't say that. Ask them to complete that. Then let them also, so as an audit, let us not only try to find fault, let them also do a bit of hand-holding exercise. Ask them to complete the record so that will be a better compliance for them. And you maintain a record for your internal purposes or for the quality of your audit. You should document the team which verified the register and the time when they have verified the register, so that you have a record that the particular asset was lying at a particular place on that day. They could have shifted on the next day, but as on the date of our verification, the asset was lying at a particular place. Then clause 3.1 AP about intangible assets. There is a vast host of intangible assets which are now held by the companies. So get a list of the intangible assets. I'm very sure all of us know that at least the accounting package held by us as chartered accountants, whichever package you are following, is an intangible asset for you. The companies also will be having the same accounting packages, or they have got patents, copyrights, trademarks. They may share a space in the servers of some other company. Right to use of the assets, software, their own ERP systems, so on. So obtain a full list of intangible assets from the management. In Schedule 3, they have also changed the assets have been bifurcated into PPE and also intangible assets, which should be maintained by them separate and distinct from the fixed assets. So you take a list, examine the list with the values in the financial statements. That anyway you will be doing it, as to the basis on which the financial value are given. and also compare the financial cost involved so that it is being valued at a proper level. Then you examine the agreements with third parties for the terms and conditions, duration, valuations, etc. I wanted to slightly elaborate on this because this is a new concept, Schedule 3 Intangible Assets. We found that some of the members have not given a lot of attention to this. So examine the agreements with third parties for the terms and conditions. So for how long can you use the asset? Right to use of the asset. Or if you are having a copyright and a trademark, what is the duration? You could have bought a trademark from a third party. You could have bought a patent from a third party. What is the value and what is the duration for which they are given to you? Only the balance period of the trademark will be available to them. And it should be amortized over that period. Examine the basis of amortization of such intangible assets as to the value at which it has been amortized and the basis for such amortization. So the next thing would be verification of PPE. So the CARO says that depending upon the nature and size of the company, if the assets are verified, verification of assets is done once in a period of 3 years, it will be a due compliance with the requirement of law.
So that only is applicable only where the size of the company.
So that only is applicable only where the size of the company is large. Imagine a company and if the assets are verified at least once in a period of 3 years, it will be due compliance. Am I audible?
Yes, sir, you're audible.
I'm audible, okay. If the size of the company is not big, then you cannot accept the 3-year term. It depends upon the nature and size of the company. A company like say Hindustan Lever or a Reliance or some other company can adopt this policy, but not a small company, not a small private limited unlisted company cannot have the period of 3 years. That will not be acceptable. So in your report, you should mention very clearly that the company has got a policy of verification of all the assets in such a way that all the assets get verified at least once in a period of so and so time. So take very clearly the possibilities, take very clearly the timetable they have got for the verification, and be satisfied. State the periodicity of the verification in the report. Ascertain from the management their policy for the verification of assets. Obtain the program for verification and its compliance.
Sir, you're not audible, sir, actually. Hari Prasad, sir. Ganesh, sir, am I audible?
And the negative variation in
లాగ్ అయిపోయింది సార్. ఇక్కడ వచ్చిన కొంతసేపటికి అక్కడ వస్తుంది. ఇక్కడ వచ్చిన కొంతసేపటికి అక్కడ వస్తుంది.
black. There seems to be a technical problem. Monica, are you there?
Yes, sir, I'm here, sir. Actually. So
I'm not able to. I'm not able to
Actually,
see. Yeah, tell me.
They share the screen.
Slideshow.
Next.
Yeah. It should be the earlier one.
so we can continue the session.
Yes. So clause 3(1)(b) says verification. We are at that. There is some technical glitch, and I'm sorry for that. We could not help it. So continuing 3(b). Whenever there is a verification, there should be a record. There could be certain discrepancies. In one asset, it is a 7%. In other thing, there is a negative of 4% combined. Don't net off. Don't say that because this is 7 and that is -4. The net variation is only 3%, and therefore need not be reported. Now that will not be proper. There are some people who are of the opinion they can be netted off, but I personally feel it simply says variation. It does not say the net variation. So I am of the opinion that the variation should be reported and the question of netting off will not arise. Then we come to the title deeds of immovable properties. So the immovable property to be carried to the balance sheet, it is but natural that it should be in the name of the company. It should be in the name of the company. So you should obtain certified copy of the statement of immovable property from the company and trace them to the financial statements. Physically examine the title deeds in original. That's very important. Physically examine the title deeds of the company in original and be assured that they are in the name of the company. So a company's property cannot be in the name of the promoter of the company or the managing director of the company. It should be held in the name of the company, represented by so and so who has been authorized. And it is also possible that the original documents are not available with the company because they could have mortgaged these title deeds and have taken a loan. So obtain a certified copy of the document as lying with the banker, and also a letter from the banker saying that they are holding the asset as a security for the property and that they hold the asset. And also, if you speak to the bankers, they will also show you the original document. That is not impossible. You can get it. You can verify the original document. You only thing is you go to the bank, verify the document. Because when we go for the audit of branches, we examine the documents where they have given loan. Similarly, if you are audit of a company, if you get a letter from the management that we would like to verify the original document, the bankers are obliged to show you the original documents. And still better, now with the electronic age and all the documents being electronic digitized, you can also log into the registrar's website. There are portals which are carrying these records, and you can verify the records from the portal directly on the website of the government, and document all this from where you have verified, the date on which you have gone to the banker, what is that you have verified, If possible, also maintain the minutes of the meeting with the branch manager or the branch whoever officer has shown you the documents, and document all these things so that you are very sure that you have got sufficient evidence to prove that you carry out the job properly. So obtain certified copies of the documents and mention in the report that the originals are with the custodian and the certified copies were examined. Once you go to the banker, obtain certified copies. They will give you. And mention in the report that the originals are with the custodian and that certified copies were examined. And if you happen to verify the original, mention that also in the report, saying that the original documents are with so-and-so bank, so-and-so branch, which were examined, and they are held in the name of the company. And if it is not held in the name of the company, you got to prepare a statement. So I've given you a table there, and this is given by CARO itself. This is not my table, this is given by CARO. Description of the property, gross carrying value in the balance sheet, held in whose name, whether the promoter or director or any other relative of or an employee of the company. So this information should be given so that the stakeholders or the government would be knowing what is actually happening with this. We go to clause 3(1)(d), revaluation. Number one is, why should they be revalued at all? The reason of revaluation, the purpose of revaluation. And now the revaluation can be done only by a registered valuer. Everybody cannot do that. As a chartered accountant, I will not be able to revalue the assets of any of my clients also. So the person who should be qualified for valuation of assets, only the registered valuer, they can carry out. So examine the agreement with the registered valuer for valuation of the property and the terms of reference, which of the assets were given and what are the terms of reference. And check if all the assets are revalued or not. There's a common practice that if you take up a revaluation should be carried out of all the assets, not only those assets where you feel you're very comfortable. I revalue only my land, take only to the land. I don't revalue my building because that is depreciated. That will not be accepted. Obtain a copy of the valuation report and see the variances. Along with the report, you should always consider the assumptions of the valuer for arriving at the values. On what basis did they arrive at these values? If the auditor is not happy with the valuation, you can always refer it to a second valuer. If the values are at variance of more than 10% of their carrying values, specify the same. Normally, those assets which are in the nature of a immovable property, they are at a higher level. So give the reasons. Then 1E speaks of Benami transactions. Benami Transaction Act has been there for quite some time. Now they have made it official. Ascertain from the management if any proceedings are initiated or pending against the company under the Benami Transactions Act. How do you know? And how do you think the company will tell you? So one is seek confirmation from the board of directors. Take a management representation first. Let them say that they don't have any Benami transactions. Or you can log on to the income tax login of the company. There we can find out if any proceedings have been initiated. Take a representation from the legal department or the legal advisor of the company on this matter. So what is his perception on this? Document these confirmations to be the basis for disclosure in the CARO report. So one is let the management give you a management representation that they have no cases pending, or if there is any case pending, what is their perception? Take an opinion from the legal advisor or the law department of the company and document that either. Then take up the present status of the document. What is the status of the dispute? And are they likely to go against the company? or are they likely to be in favor of the company? But we are not expected to report on that. If there is a benami transaction, if the proceeding is on, just mention that there is a pending litigation on the company, and don't go beyond. So over to Ganesh for the next part of it. We'll go to current assets, clause 3(2). Yeah, Ganesh, please take it.
Thank you, Professor. Inventories. Physical verification of inventories forms a essential part of financial reporting, because the inventory needs to be physically verified, properly valued in accordance to AS2 or Ind AS2 as may be applicable, and the value to be taken in the balance sheet. So the management should, based on the nature and category of the assets, should have a regular system as a part of internal control of verification of physical inventory. So we have to report whether there is a process of physical inventory verification and whether the verification is reasonable keeping the nature and size of the business. Invariably, the verification should be done once in a year, whether at the year end or before the year end. According to the reconciliation has to be done to arrive at the closing stock. So whether the physical verification is done at reasonable intervals and there is a variance. So again, the threshold limit has been put where there is a variance of more than 10%. So as already told by Mr. Kali Prasad Garu, that there should not be any netting off. There is an excess inventory in one case and short inventory in another category of raw material inventories. Both should not be netted off. Each should be categorized and quantified and reported upon, and whether there has been proper adjustment. See, even if it is properly dealt, the variance has been properly dealt. Earlier we had been reporting that the variances have been properly adjusted in the books of accounts. But if the variance is more than 10%, and even though adjusted, it has to be reported. The stress is that even if there is a discrepancy of 10%, it has to be reported. It is not that it has been adjusted, so it need not be reported. That's not the standard. Then what is inventory? We should understand, differentiate inventory from other stock held by the entity. So it should be held in the ordinary course of business, the process of production of such sale or services. Okay, the word services in or in the form of supplies to be consumed, the production process. So it does so spares and parts and standby equipment are not part of inventory and should not be valued as an inventory. They are separate, they come under assets and it should be valued accordingly. Then the part 3, clause 2, subclause B. Our reporting requirement under inventory does not end about the quantification reporting on inventory. We should also report where the exposure limit from the working capital exposure limit is in excess of 5 crores at any point of the year. The reporting requirement is whether the inventory statements and the quarterly returns or whatever inventory statements submitted by the bank, by the entity to the bank, or in compliance or in agreement with the books of accounts. So we have to compare. For example, if a bank, it is a quarterly statements. The thing is not the monthly statements, or the quarterly statements given to the bank, and the books of accounts are in agreement with each other. So the account should be maintained in such a way that we are able to arrive at the quarterly stock and other items. For example, in the quarterly statements, normally the creditors, debtors, and other receivables are reported. So our reporting requirement doesn't end with seeing whether the inventory is in agreement with the books of accounts, but also the debtors, creditors, the aging thereof, everything should be in agreement with the books of accounts. Then here again, materiality has to be considered. It is the secured working capital loans. Many companies do get loans as an unsecured loan for working capital. As it is a banking norm, many banks do give unsecured loans against the stock, and there is no charge created against the stocks. So this reporting requirement, whether it is an agreement with the books of accounts or not, is only in cases where the working capital is given as against the security of current assets, and the same has been given to the bank. Over to Kalpasada.
Sir, you need to unmute yourself, sir. Kali Prasad, sir. Kali Prasad, sir, am I audible? Sir, you are like unmuted yourself, sir. Actually, you need to unmute yourself, sir. Yes, sir. Thank you.
Yeah, it's very much on. It's very much on. You're not able to hear me?
Yes, sir. You are audible, sir.
Monica?
Yes, sir. You are audible, sir.
Okay. So while changing the CARO, earlier it was only on stocks. Now they have included receivables also. It does not stop with only inventories. So the classification of inventories should be mentioned very clearly: how much is raw materials, how much is work in progress, how much are consumables, how much of the finished goods, etc. And the clause says at reasonable intervals. Now, what is reasonable interval is a matter of judgment. It varies from industry to industry, it varies from unit to unit. So firstly, obtain again from the management what are the classes of inventory they are maintaining. Whether it is only raw material, in raw material again, the different categories of raw material. You take a furniture maker, raw material of steel, raw material of wood, raw material of maybe polish, raw material of the boards, whatever they have. Different classifications of raw materials. So obtain the classes of inventory, and up to what point of time do they take it as work in progress? Based on the nature and size of business, conclude if the frequency they have adopted for valuation is reasonable or not. Because it's always subjected to the nature and size of the business of the activity. So the auditor can decide whether the frequency is proper or not. Document the reasons for satisfying yourself about the appropriateness of the verification process. One is the frequency at which it is verified. Second is the method of verification. Normally, in case of large borrowings, banks also verify the stocks. They may appoint a stock auditor. So it is the responsibility of the stock auditor also to verify the stocks. If the stock auditor verifies the stocks and gives a report, that will be considered to be a valid and acceptable verification. So you should also get the report of the stock auditor. So the inventory is part of it. And in case of large borrowers, here the word says is limit. Calculate the total of the facilities and not the individual limit for each facility. And if the aggregate facilities are in excess of 5 crores. Now here, what they said is the aggregate limit of 5 crores. There could be a OCC limit, there could be a KCC limit, there could be a bill discounting, fund-based, non-fund-based, there are different kinds of limits. And if the aggregate exceeds 5 crores, then you've got to do additional work. And the word used here is limit, not the balance. There could be a limit of 6 crores. I could have used only 4 crores. Then I cannot take a plea saying that my balance is only 4 crores. It is only the limit, and limit in the aggregate. So in such cases, if it is more than 5 crores, obviously the borrower is required to file quarterly returns. This is where the receivables come into play. Examine copies of the quarterly returns filed with the lending institutions and compare the same with the books of account of the company. And if there is any variations, simply report it. You should also document the reasons as to why you are reporting it. So examine the total facilities. Examine the total limits. Then exercise this. So for the next clause, Ganesh will take over. Clause 3.3.
Yeah. Loans and advances. The reporting requirement on loans and advances have been substantially increased, and specific replies have to be given. The language used has also been changed. Earlier, it was a maximum limit or the minimum or maximum amount outstanding, minimum amount outstanding. These were the words used. Now, the stress has been given to aggregate amount during the year outstanding on balance sheet date. These are the stress has been given. Earlier, it was restricted to related parties. Now it has been given loans and advances, or advances in nature of loans have been given. So there could be an advance that the clientele or the auditee could say it is an advance. But see the purchase order. See whether it's an advance or it's an advance in nature of loan. Because if there is a supply to be made, you see the normal industrial practice and see whether it's an advance or it is a loan. Based on that, the reporting requirement triggers. Here, the word used is the aggregate amount outstanding during the year. Aggregate amount advanced during the year. So, if there have been 12 instances, every month a 4 lakh rupees is given and squared out by the end of the month. The cycle goes on, and at the end of the year, there is no amount outstanding. But the amount of 48 lakhs has been advanced and repaid during the year. So that requires a reporting requirement. And there is a specified format of reporting which has been given in the order itself. And the report has to be, this report should see that the details are given. So for this, we can go to the loans and advances by analysis of the balance sheet, the related party transactions from 187 and the register maintained under 188, the guidance notes of the ICAI, the SEBI LOD of regulations, RBI directions, and we should see analytical procedures. Here we should use SCF 520 analytical procedures to analyze the transactions and see whether there have been transactions have been squared out, and the same needs to be reported. Over and above the aggregate amount transacted during the year, the outstanding as on balance sheet date has also needs to be reported. Continuing, the loans and advances, the investments made or anything, they are not prejudicial to the interest of the company. It is a judgmental thing. We should see whether the advance given or loan given is prejudicial to the interest of the company. For example, if a loan is given to a subsidiary, a loss-making subsidiary, to meet its requirements, it may not necessarily be prejudicial to the interest of the company. In each and every situation, we should take proper judgment and document as to how the judgment has been arrived at. At any point of time, the documentation requirement has to be complied with. Then go to the transactions, whether the loans and the service of loans and advances. As we do the bank audit, we have to carry on the habit of the culture of bank audit through the entire audit period. In case of loans and advances, whether the schedule of repayment has been regular, whether it is principal or interest, and whether there has been a delay of more than 90 days is also there. This needs to be reported. So the NPA reporting of bank audit continues here. We need not tell it is an NPA, but we have to tell that there has been a delay for more than 90 days. Then whether the reasonable steps have been taken for recovery of principal and interest. So what is reasonable steps? Whether a legal notice is to be given or whether action has been taken, whatsoever action has been taken should be looked into and documented. If you are satisfied the steps are enough, we can say the reasonable steps have been taken for recovery. Then ever bleeding of loans. See, there could have been a process that a loan has fallen due, a fresh loan has been granted to enable the borrower to repay the loan. This or a loan has been renewed or extended. The stress is whether the loan has been renewed or extended to settle the existing loan, and what is the aggregate amount of such loans renewed. So this also needs a reporting requirement. Then loans repayable on demand. So there could be an advance or loan. The management says that these loans are repayable on demand, and there is no interest to be paid. This also needs to be reported. Overall, the scope of reporting of loans, whether to related parties or not related parties. So earlier it was only related parties. Now the reporting requirement covers all loans, whether related party or not, and it has to be reported. Then a specific reporting requirement of related party loans, whether the adequate approval has been taken by the audit committee under 187 and it has been entered in the MPT register and independently given at arm's length, this has to be reported. Over to Kalvisas.
I have my assistant, Ms. Pranati, sitting here, and she has been very helpful, reminding me you switch on your mic or switch off your mic and this, that, etc. My special thanks to that girl for being very helpful. I'm going on record. So clauses 3, 3, and 4 seek a management representation about the investments, guarantees, or advances in the nature of loans given to other entities. Let the management come out very clearly. And if the number is more, if they have got multiple investments or multiple things, ask them to maintain a register of investments. Many companies do that. Examine the register of investments or register of guarantees, etc., and cross-check them with this. Also, you decide if a mention of these guarantees given should be disclosed as a contingent liability. Because if I give guarantee to Ganesh, then I should mention in my balance sheet saying that I've given a guarantee to Ganesh. Let my shareholders also know about it. There should be a mention in the notes to accounts. So seek a management representation about the investments made. So verify the investment register, verify the guarantees register, and also ensure that the financial statement contains these guarantees as a contingency. And the best part is advances in the nature of loans given to other entities. They say that it is an advance, but in effect it is not an advance, it is only a loan. By whatever name you call, it is money given. And the concept of maybe substance over form should prevail here. They say that it is an advance as far as the financial statement is considered, but it could be a loan. There could be a company They could have given some money to another company to ward off the difficulties as disclosed by Mr. Ganesh. Now, I will not say that as a loan because a private limited company is prohibited to give any interest-free loan to any other company. But then they are known to me, my good friends, so I want to bail them out. I could have given some loan to them, no interest. So I show it as advances. Now advances are what? So spend some time on the nature of the transaction. What is the reason for giving the advance? Does it really require an advance to be given? In totality, carry out an auditing in depth of the particular transaction. As to have they started the manufacturing activity? Are they in the process of giving it? Will they be giving it? Is there any agreement to support the advance? Look into these aspects also and be very sure that whether it's an advance or a loan. Examine the variation in the respective accounts. So there could be an investment register. Call for the investment register, check the demat account and see whether in the demat account these number of shares are being disclosed or not. Examine the guarantee register and say whether that has been shown in the financial statements or not. So you cross check, examine the variation, inquire into the changes during the year. I could have pulled out my investment in company A and put it in company B. So when did I pull out of this company? How much did I get? How much did I put in the other company? In case of advances, you've got to indicate whether there's a variation or not. This is very important. In case of advances, whether there is a variation or not, we should mention very clearly name of the entity to whom we have given the advance, nature of the transaction, value of the transaction, and the closing balance. It could be both on the assets and also the liability side. Inquire the reasons for such transactions. Obtain reason to be satisfied that such transactions are not prejudicial to the interests of the company. So the term prejudicial to the interests of the company is very subjective and it varies on a case-to-case basis. In respect of loans and advances, examine the agreement or MOU for the tenure of the loan, for how long, how about the interest component on that, closure of the loan, or what are the penalty for any foreclosure of the loan. These things should be verified. Also, going by the object clause of the company of which you are auditing, check whether the company can give loan to another company. Because company A has been started to carry out their own business, giving of loans to others is not the objective, it becomes an NBFC. So check whether giving such loan is ultra vires the objective clause of the company also. And if it is acceptable, then you see whether these stipulations have been complied with. So examine the MOU, examine the date of transaction, how much interest is given, whether that is prejudicial to the interests of the company. I borrow from bank at 10%, I give to them at 6%, it is prejudicial to the interests of the company and also to the shareholders. And if any loan has fallen due during the year, whether the loan has been received or not, or the loan has been rescheduled, whether the due date has been extended, and the steps taken for the recovery of such loan. If you remember last year and the year before, because of COVID, government itself has come forward saying that most of the loans, including housing loans, have been rescheduled. They said that they have extended the due dates by about a couple of months, 3 months or so, depending upon the nature. They have reduced the interest rates for those 2-3 months. So these things, because that will come into the balance sheet this year, 21-22. So you should exercise caution on those acts. And we should extend vigil that no fresh loans are given for the other person to settle the existing loan which is on the verge of becoming an NPA, and this is called as evergreening of loan. I don't give a loan whether directly or also indirectly. I give a loan to A gives a loan to B gives a loan to C ultimately gives loan to D, now in whom I am interested. So I have taken a longer route only to accommodate D. That will be an evergreening of a loan, and see whether the audit trail or the document trail would be useful. follow the trail and examine the document in detail. Such links. The above provisions do not apply to those companies whose principal business is to give loans. So if it's a finance company, whether a banking finance company or an NBFC, these provisions don't apply there. They got different set because the NBFC norms, they require various reporting to be done. Examine if the company has given loans or advances without stipulating the repayment terms or loans repayable on demand. In case of such loans, you should indicate. Now here you should indicate only in case such loans have been given. If there are no such loans, you state as such in the CARO report. State that the company has not given loans or advances without stipulating the repayment terms or the other stipulations. But if there is any such loan given, you got to append the table. Aggregate amount, percentage of such loan to total loans, aggregate of loans granted to the promoters, aggregate of loans granted to the related parties. Seek an MR whether the provisions of section 185 and 186 of the Act have been complied with. I think Ganesh has already covered that. Yeah, back to Ganesh for the next clause.
Extending deposits. Section 73 to 76 deal with deposits and whether the deposits have been accepted by the company. So over and above deposits, there is something called deemed deposits under the Companies Act. The maximum threshold limit of any advance received should not cross 365 days except for an infrastructure company. So if then this becomes a deemed deposit and the deposits rules, acceptance of deposit rules will trigger it. So it is not only the deposits accepted as deposit, it is the deposits, the amounts received as an advance or otherwise which turn out to be deposits. So in respect of the company which has whether they have complied with the RBI directions. RBI directions are there and there are also other directions under the Companies Acceptance of Deposit Rules 2019. This has been amended from the original rules given in 2014. This has to be ruled. There has to be complied with. There are certain exemptions. You should read it with the rule 2(1)(c) of the exemption for deposits, and we should see this is compliant. This has been existent for over a long period of time. In this context, I would like to tell that any application money, share application money received and pending for allotment for more than 60 days, or any other securities, not only share application money, debentures, or any provincial shares, or whatsoever it might be, received by the company and not being allotted, will turn out to be deposits. In case of share application money, it should be remembered that all the share application money should be kept in a separate account till the date of allotment and should not be used otherwise. If it is used, then it is a contravention of allotment of shares provisions, and we should take care and see that these amounts are properly deployed. For this, again, I'll tell you proper analytical procedures, and we should go beyond. The company need not treat it as an advance or need not treat it as a deposit. But we should go through the trial balance properly, go through the proper ledger scrutiny needs to be done to understand whether any amount received by the company could turn out to be a deposit. Because tomorrow the shareholder, the person who has advanced such money, could proceed against the company, and as an auditor, we could become liable for default.
Default. They don't say that it is a deposit, but in effect, it is a deposit in the garb of an advance, or it is an application money, or whatever it is. So provisions of section 73 to 76 of the Companies Act should be complied with. Again, seek an MR, management representation, that they have complied with these provisions. Also, going into the circumstances under which this transaction has taken place, you should be able to establish whether the company has properly complied with 73 to 76 or not. Discuss the nature of non-compliance, if any, with those charged with governance. Because they are the people who have got to answer these questions. For everything, we don't go to the board of directors. So discuss with those charged with governance as to what are the compliances and non-compliances. And also seek from the management and the legal department or the law advisor whether any orders have been issued by NCLT or RBI or CLB or any other court or a tribunal, and study the orders, whether there have been any orders, whether there has been a proper compliance with or not. And any non-compliance with respect to these things should be reported by the auditors. Yeah. So Ganesh will take you through the maintenance of cost records. Yeah, Ganesh.
Thank you, Mr. Cost records. The reporting under cost records has been there in from the CARO days, and it continued in CARO, though a small respite in between, I think, and it continues now here. Reporting requirements stands the same, whether the adequate records have been maintained and as per the prescription made by the Companies Act. So it is not whether cost audit is applicable or not. We should see even if cost audit is not applicable, the cost records should have been mandated under the Act. So we should go through section 148 and the rules, cost audit rules, just separately prescribed, and see they have been complied. There are certain categories of companies where cost records have been maintained to arrive at the cost of goods and services manufactured or rendered by the company. If that is done, it will suffice. We need not do a detailed audit of such records. We need not do a detailed audit of such records. Just a cursory examination of the records would suffice.
So to comply with the requirements, again, let the management, involve management at every level. Seek a management representation whether the provisions of maintenance of cost records apply to the company or not. If they are not applicable, we also know from the rules, cost record rules, whether they are applicable to a company or not. You satisfy yourself whether there is a requirement or not of maintenance of cost records. And examine the cost records. It only requires as Ganesh was saying, that what we require is only a reasonable assurance. You don't have to verify all the records, and only reasonable records. And if you are satisfied with that, you mentioned that reasonable cost records have been maintained by the company. And in addition to that, if the company is liable for cost audit, examine the cost audit report. And in case the cost audit report gives a qualification with reference to the maintenance of records, and you say that reasonable cost records have been maintained, you are contradicting the view of the cost auditor. So establish caution and say that the cost auditor has mentioned that cost records have not been properly maintained. Carry the same thing into your audit report or your CARO report also. Yeah, so over to Ganesh for the next clause.
Statutory dues. What are statutory dues? It is an inclusive definition that has been given in the reporting clause. It says statutory dues including goods and service tax. They have changed it from excess duty in the earlier provision, provident fund, ESI, income tax, sales tax, etc. But we should understand that this is only a inclusive list. We should take care and see whether the regular dues like property tax or any license fee to be paid by the company, and all such the local levies. We should understand the nature of business and see what are the levies to be paid by the entity regularly and whether they have been paid. For example, a custom duty is not a regular statutory levy. It depends on the import. So there is this thing. Every company it is not applicable. But property tax, if you are holding property, property tax needs to be paid regularly, and if there's a default, we have to report on it. So in this case, we should see all the laws applicable to the company. SA 250, consideration of laws and regulations applicable, other laws and regulations applicable to the company, NOCLR report required for listed companies. These things have to be taken care, and we see that all the taxes due have been paid and there are no outstandings more than 6 months. So the threshold is 6 months. If it is made good before the end of the year, there will not be any reporting requirement. Amounts deposited on account of dispute. This is also had been there. More clarity has been given. So you should note that a representation of 154 for rectification or a representation of 264 of Income Tax Act or similar representations under Goods and Service Tax Act or whatsoever it is a dispute. Dispute means not only going to the tribunal or CIT appeals or the first appellate authority, even a presentation to the assessing officer for reconsideration is a dispute, and the amount not paid is a disputed amount unpaid. Any dispute subject to reassessment is not a dispute. So the reporting requirement is whether statutory dues suffered in Clause A have not been paid on account of dispute, then the amounts involved and the nature of dispute should be reported upon. And in this case, we have to take care the events occurring after the balance sheet date and any demand arising having effect on the status of the financial statements has also to be taken care and reported upon.
There are two parts to the statutory dues. One is disputed taxes, other is undisputed taxes. Any disputed tax has got to be reported, irrespective of the duration of the dispute. And in case of undisputed taxes, we should only report if it is outstanding for a period outstanding for more than 6 months as on the date of the balance sheet. And in my opinion, even if the company fails to have paid the advance tax for the last 2 quarters, the December and March quarter, this should be brought out in the report because it is a statutory due and the company has not paid. So if the company has paid only the advance tax due in September, but the company has not paid the advance tax due in December and March, that should be brought into the report. You can access the income tax in the GST portal with the company's login. Use the company's login directly, they should give you access. Then determine what are all the taxes payable. If you see in the income tax side, if you see compliance, you will come to know what are all the compliances which are pending, and that will give you adequate input as to what are all the dues of the company. So take a cue from there and then discuss with the management and put it in the report. So you should give a table, serial number, nature of dues, year, due date, and the amount. Even if the company has not paid the advance tax in December and March, mention very clear serial number, nature of due, say advance tax, year, assessment year 22-23, due date is 15th of December, amount is so much, not paid, undisputed taxes, or the statutory dues. And when it comes to disputed taxes, you should mention very clearly whenever there is a dispute, you go for rectification under 154, or you file an appeal before the Commissioner of Appeals or whatever is the authority, or you can refer the matter in Vivad Se Vishwas. You should mention here. It becomes a disputed tax. Mention very clearly nature of the pending dispute. What is pending? What kind of a dispute is pending? Amount involved and forum where the dispute is pending. Should give the clarity. So you take a representation from the taxation department, full particulars of all pending disputes and the forum where the dispute is pending. and report the same and the date from where it is pending. So that will be a due compliance with this requirement of law. So Ganesh will take you through next clause.
And the amount is not deposited. The disclosure and the reporting requirement is amounts not deposited. For example, we go to CAT appeals and we deposit 25% on the amount deposited, amount disputed. That same can be netted off. The amount not deposited is only the 75% of the disputed amount, and 25% has been deposited. So modification reporting structure can be made. We can tell that so much amount has been deposited and so much is not deposited. Now coming to the next clause, amount disclosed, surrendered or surrendered. Here, normally in course of search, survey or any proceedings by the department or even during the assessment proceedings, certain amount might have been surrendered as income during any of the proceedings. Then such amounts needs to be reported. For this, we need to go through the income tax proceedings conducted on the company or any other proceedings. Let it be the Income Tax Act or the GST Act or anything, some amount has been surrendered and it has an impact on the financial statements, whether they have been recorded in the books and properly brought into the books. So if it is a previous year transaction, it becomes an extraordinary transaction, not a prior period item. So there is the emphasis on the amounts surrendered or disclosed in the income tax assessments or any other proceedings. It need not be the income tax proceedings only, whether it is any other proceeding which has an impact and has an impact on the financial statements, it needs to be disclosed and reported upon. This is an additional new reporting requirement. So we have to see the proceedings under 158B of the Income Tax Act and any statements given during the survey and search proceedings which we should take into consideration, and if they have voluntarily surrendered the amount, we should get it. The Vivad Se Vishwas scheme, if it has an impact in the current year, because already the scheme has closed and it should have been dealt with accordingly in the previous year financial statements. But if it has any impact in the current year financial statements, it has to be disclosed. And this can have an additional impact on the efficacy of the internal control for financial reporting. If there is an error in reporting and it has resulted in the disclosure under the Income Tax Act, it has to be properly dealt in the IFCOR report. Over to Kalpasar.
Undisclosed transactions. This is a very crucial item. So examine the latest assessment orders which have been released during the year under audit. If any additions are made. Additions could be, number one is disallowing any expenditure which has been claimed or bringing in fresh additions liable to notices under 270A. Where the company has accepted such additions, then it leads to lots of complications. There are also situations where the tax auditor was pulled up for not bringing out these in his tax audit report. So you should exercise caution where any additions are made. And if there are any undisclosed transactions, there could be a search, there could be an income tax raid, and the company might accept certain additions or certain income. It should be reported under this undisclosed transactions. And when these are reported, when the company has accepted certain additions, where is that accounted for? That's the next important thing. Where the company has accepted certain additions or has accepted certain undisclosed transactions, two things would come into operation. Number one is the company has given us a representation. In the management representation, normally we take that all transactions entered into by the company have been recorded. where suddenly they accept an unrecorded transaction, they are contradicting themselves. So this will vitiate any such management representation. Secondly, when they have accepted any income, that should be properly accounted for in the books also. There was a question where such additional income accepted by the company would be eligible for declaring a dividend. Now, that's a different forum which I don't want to discuss now, but I am only giving a seed for you to think about. So undisclosed transactions have got to be done. So we'll take a break here. We'll take a small break. We'll come back in 5 minutes because it's about half time. So I will have a glass of water and you can also relax and come back. Thank you.
Thank you, sir. I'll just call after 5 minutes.
Okay, please. Sure.
Yes, sir. Sir, can we start the session, sir? Sir?
Can I start? Yeah. So video on change.
Welcome back, friends. So the loans taken. Now, in addition to the various requirements, this loans taken as service to of loans
Sir, there is
has been substantially enhanced. Earlier, it was loans taken from a financial bank or financial institution.
Vinay, sir.
Was the wording of the reporting clause. Now it is modified to say any lender. So whether money is taken from a financial institution or a private lender, it has to be reported upon. Whether the company has defaulted in repayment of loans or other borrowings and payment of interest thereon to any lender. If yes, mention the period of default. So preferential share capital is not a part of borrowings. The repayment of deposits is separately covered under 3.5 of the order. So it is not covered here. Then any defaults as on balance sheet date should be covered irrespective when the default has occurred. So it is, we should not tell that earlier I mentioned that the events during the accounting period. So in case of default in repayment of loans, it is loans taken in the previous year and defaulted in the previous year, and continuing defaults is a default. Loans under the process of restructuring is also a default. If it is restructured, the process is complete and there is no default. But if the process it has been, it is a process of restructuring, we should consider it as a default and report it. Unless the restructuring process is complete before we sign of the balance sheet. And in the case of reschedulement after the date of balance sheet, we should tell that there has been a default as on the balance sheet date and the reschedulement has been done. So there is no default. Loans repayable on demand, written representation has to be taken that there is no default, and we should even go for third-party external confirmation from the parties where the loans have been taken. So we should see the compliance of AS 320 materiality, 230 management representation, 505 external representation, 580 written management representation, and external confirmations to be obtained in case of service of loans. Then willful default. Over and above the default, whether there's been a willful default, means where does the willful default arise? There is an ability to pay, but intentionally there has been a delay in the repayment of loan. So whether whether the company has been declared as a willful defaulter by any lender, In case of banks and financial institutions, we can go through the website and say that the bank has reported this entity as a willful default. But how do we see in case of a lender? Any other than bank or financial institution, we should correspond with the party and whether any action has been initiated by the party who is a lender other than a financial institution, and confirm that the party has not declared this party as this company as a willful default. That would, if it has been declared as a willful defaulter, the reporting has been done. So we should go through the analytical procedure, properly analyze, see whether the loans have been utilized for the purpose for which it has been used, which has been sanctioned. A loan has been taken for purposes of a particular machinery. A new version of the machinery is purchased. It is not a diversion of loan. Whereas a loan has been taken for the purchase of machinery, land has been acquired. It is a diversion of loan. So similarly, there is a correlation between short-term loans being used for long-term purpose, deploying borrowed funds for investments, for creation of assets for which the loan has been taken, assets other than which the loan has been taken. This needs to be properly verified, analyzed, and reported upon. Many of the corporate failures have occurred because of loan diversion. Utmost care has to be taken about the utilization of loans. These loans taken might be deployed, diverted to subsidiaries or related entities, or given as advances in nature of loans. This needs to be properly analyzed and reported upon. This has already been covered. Yeah. Then loans taken for meeting the obligation of subsidiaries. Whether any loan has been taken to meet the obligation of subsidiaries, and accordingly the loan has been deployed. This has to be separately reported upon over and above the earlier reporting requirements. The movements of funds taken and received back, as reported earlier, the earlier process also, the loan has been taken and passed on to the subsidiary and repaid back, has to be also reported in this clause. Borrowing of funds by pledge of investments in subsidiaries and associates. Under the LODR requirements for listed companies, any borrowing by pledge of shares of the promoters is already reported as a separate requirement under the LODR regulations. Similarly, if any investments in subsidiaries and associates have been taken, have been pledged and loan taken against such subsidiaries, this needs to be reported as a reporting requirement under this clause. The investments clause under Schedule 3 should also disclose that these investments have been pledged and loan has been raised. This is a corresponding requirement of the disclosure under Schedule 3. So security has been defined in the reporting under these clauses. We have to consider various clauses like the Securities Contract Regulation Act, the Section 77, Section 281. All these sections need to be considered while reporting under this clause.
So clause 3.9 assumes great significance because of the defaults. So we should know what is a default, what is not a default, or misuse of funds taken for one purpose and used for another purpose are covered under this. So seek a confirmation from the company about any default in repayment of loans. So whenever there is a loan, as a good audit practice, you should obtain the sanction letter. That's very important. That should be in your file as long as the duration of the loan is on. The terms and conditions which should be applied year after year. So you verify the repayment terms and see whether there has been any default in repayment of loans. In addition to that, seek a confirmation from the borrowers, from the company about any default. And it should be reported in the following format, which is given by CARO itself. So it should be reported in the format giving the nature of the loan and from whom it was taken, nature of default, whether it is principal or interest, the number of days of delay or default, etc. And in clauses 3, 9, B and C, examine the correspondence with the banker or the financial institution or the lender if the company is declared as a willful defaulter. Now the question of who is a willful defaulter has already been explained by Ganesh. I have money, but I don't want to pay. The willful defaulter. There are any number of examples of willful defaulters now in our country. So scrutinize the deployment of funds. So the next clause says utilization of funds, where the funds have been used for the purpose for which it has been taken. If I take a housing loan and I use it for my factory building, it will be a misuse of funds. It could be a company which borrows money for developing a housing complex for their employees. That will be categorized as a housing loan. But the money has been utilized to build some other activity. It would be misuse of funds. And we should also examine the audit report, if any, on the borrowings and their utilization. So there could be a special audit carried out by the lender. He could have instituted an audit into this, and on the borrowings and their utilization, they may insist upon end use. So examine that report, relying upon the work of other experts. Seek a management confirmation for the end use of the asset. Any diversion of the funds for the purpose of for which it has been borrowed should be reported. Then when it comes to short-term borrowings, shall be used only for short-term purposes. Short-term purpose is generally for a period not exceeding 12 months. Examine the details of such borrowings and obtain a confirmation from the company whether or not the short-term borrowings are used for the intended purpose. Trace the deployment of funds. Any deviation and amount is to be reported. Here, a careful scrutiny of the cash flow statement of the company would be of great use to you because of the classification. Investing activities and financing activities that will be able to give you a good idea on whether the loan has been raised and used for what. So you go through the forecast and see the increase in current assets supported by increase in current liabilities, or increase in current assets supported by increase in long-term liabilities. These things will give you the reason as to why you should be reporting or not. Then we have funding of subsidiaries. If a company has got an associate company or a joint venture or the subsidiaries, and if a parent company borrows money for helping them, again the concept of evergreening, to meet the obligations of any of its subsidiaries, associates or joint ventures should be reported. Because the company, only for the purpose of consolidated financial statements, we consolidate, but for the operations, we don't consolidate. Holding company cannot borrow money for meeting the liability of its subsidiary because it is a standalone and it should run the difficulties by itself. Also, a holding company has got investments or in a subsidiary, and the subsidiary also has got their own securities. So company A has got a subsidiary, company B. So the subsidiary company may be having some securities. They are pledged by company A and they raise money. This again amounts to a reportable part. And they could have borrowed money. There may be a default, and the pledge could be appropriated by the lending institution, which is bad in law. So if the company borrows money on securities of the subsidiaries, inquire of the management, obtain a management representation, and if there is any default in repayment of such loans should be reported. It is not a violation if they borrow the money, but non-paying of the repayment of liability on the borrowing would be reported. So Ganesh will take you through clause 310. Over to Ganesh.
Utilization of funds raised by an IPO or FPO. Where monies have been raised by IPO, initial public offer, or further follow-on public offer, FPO, including debt instruments during the year, are applied for the purpose for which they are raised. If not, give details. Normally, when an IPO or FPO is issued by the company, funds are raised by IPO or FPO by the company gives the purpose for which the IPO is made in the disclosure, in the issue document. And though there is no specific reporting requirement under Schedule 3, the board report normally discloses the utilization, and even there is a separate auditor's certification requirement about the deployment of funds in case of listed companies. So we should go through the IPO offer letter or FPO offer letter and see whether the amounts are being utilized and not deployed for any other purpose other than the specified purposes. This is the specific new auditing reporting requirement, and we should be careful when doing reporting under this clause. In going along with the IPO and FPO, there could be a private placement or a preferential offer. Whether there has been a private placement or a preferential offer during the year, and if the money has been raised, how they have been deployed. And in case of private placement or preferential offer, the specific requirement is whether the company has complied with the section 42 and 62 of the Companies Act, and the funds raised for the purpose. So it's very specific. We should go through section 42 where the requirements are tell how the FPO has to be made or a private placement has to be made. What's the pricing norms? How the money has to be kept in a separate account and further deployed. Here, any non-compliance needs to be required. If there's a compliance, that has been complied would suffice. A private placement goes with an offer to invitation, offer or invitation to subscribe, and there's the offer come application letter. These should be properly documented, and unsaid is that it should be paid within, allotment should be made within 60 days, or otherwise it becomes a deposit.
So whenever an issue is made, it is mandatory for the company to keep the money deposited in a separate bank account till such time the allotment is made. So firstly, inquire of the company if it has raised funds, either equity or debt. It does not stop only with equity, either equity or debt during the year, and the route it has taken as to how the money has been raised by a company. Examine the offer document, prospectus or the offer document by whatever name called, to understand the objective of the issue and study whether the funds have been used for that purpose or not. cross-verify the data with the NCA master data and ensure that the numbers match with each other. Any deviation from the offer document is to be reported. And even in case of a subsequent rectification, the auditor has to report the nature of deviation and also the rectification. You're going to report on both. The deviation and also the rectification should be reported. And when it comes to private placement, where the shares and debentures have been issued by private placement or preferential allotment, whether the provisions of section 42 and 62 have been complied with, should be studied. Any non-compliance has got to be reported, indicating the nature and the size of the deviation, how much of money has been used for a purpose other than that. So, Ganesh to take over for clause 311.
Companies Act 2013, section 447 has specifically defined fraud. So we have to see whether a fraud has been committed by the company, on the company, during the year. And if it is yes, it has to be reported. Earlier, the same clause was there in the previous requirement, CARO 2016 and CARO 13. It is also there specifically under section 143 clause 12, whether the fraud has been detected. Here in CARO, we have to report whether there is a fraud detected, there is a fraud has been committed on the company or by the company. Earlier, it was restricted only to the officers or executives of the company, employees of the company. Now it has been increased beyond that. So it covers the cyber frauds, or any other fraud by third party. It is restricted to the frauds noticed or reported. We need not do a separate fraud detection audit and report upon. It is only the frauds that have been detected, noticed or reported. The frauds can be detected by a cost auditor or an internal auditor or any other auditor, by the stock auditor employed by a third party. Such frauds has to be reported here. Even whistleblower reporting requirements have been added here. And if the whistleblower says there has been a fraud on the company, it has to be reported here. There is a specific audit reporting requirement under 143.12. If a fraud has been detected, it has to be immediately reported to the management, audit committee, and the board of directors within 7 days, and they have to respond within 15 days, and that has to be reported to the central government. There is a threshold limit for reporting to the. Thankfully, there is a threshold limit for reporting to the central government. The amount has already been specified as 1 crore. Whistleblower complaints. Whistleblowers complaining mechanism is applicable to a registered company or companies which accept from deposits from public, and companies which have a borrowings exceeding 50 crores during the year. So there should be a whistleblower complaint reporting mechanism. The whistleblower will report to the board of directors, and if any complaint has been made, that has to be considered by the auditor and reported out. Even if the company establishes a whistleblower complaint mechanism voluntarily, it has to be considered and reported. There are separate reporting requirements in the civil LODR regulations and 177 of Companies Act. In this case, better we obtain an MR and consider the reporting requirements.
So this clause 11 deals with the frauds by or on the company. Number one is obtain a management representation whether there have been any fraud which have been identified during the year. Fraud might have taken place a couple of years back but is identified this year. Then it should be reported only in this year, in the year in which it has been identified, not the year in which it has been committed. The nature and fraud involved should be reported. What is the nature of the fraud and what is the amount? And the persons who have committed the fraud should be also mentioned. Any details of ADT 4 filed with the MCA should be specified. That's the form where we report frauds to the MCA. Consider cross-reference to inventories, benami transactions, and additions under the Income Tax Act, and that could be a fraud. In one of the earlier clauses, we have seen whether the company has accepted any additions under the Income Tax Act. That could be the result of a fraud by the management of a company. So that should again be reported here. There could be benami transactions which are accepted by the company. It could be a fraud. The company wanted to hide it, but it has not been possible. So the audit committee is entrusted with the whistleblowing mechanism. It is the responsibility of the audit committee to make a provision for somebody to inform them if there is something going wrong. Discuss with the chairman of the audit committee about the complaints received and how they were resolved. There could be lots of complaints where they keep on raising a issue and how they have been resolved. So what is the consideration? Maybe if possible, you obtain copies of all those complaints and what were the proceedings and how and the cause for disposing of in the feeling that there is no fraud. If the fraud has been identified, that should be reported. So if any of these complaints are to be reported, maybe the fraud has not been established, but the auditor should define or decide if that has got to be reported in the audit report. Yeah. So we go to clause 12.
Clause 12 is relatively simple and it's applicable to a limited number of companies. It is only applicable to a company which is Nidhi Company under section 406 of the Companies Act 2013. Here we have to see whether the net owned funds to deposit ratio is 1:20 limit, and it is maintaining 10% of liquid cash to meet the 10% unencumbered deposits as per Nidhi rules 2014 to meet out the liabilities. This and if there is any default or repayment of deposits has to also be reported upon. What is a Nidhi Company? Nidhi Company is a company incorporated as such under section 402 of the earlier 406 of the Companies Act. And net owned funds is defined under the Act as paid up capital plus free reserves, reduced by accumulated losses and intangible assets.
The scope of reporting for Nidhi companies has been elaborated in CARO 2020. One is the ratio of net owned funds to deposits. The recommended ratio is 1:20. For every 1 rupee of my own funds, I can accept deposit of 20. If my net owned funds is 1 lakh, I can only accept up to 20 lakhs. But if the ratio is more, if the ratio is more than 1:20, the same has to be reported. It can be less than 1:20. If I have 1 lakh of my own funds, I can borrow up to 20 or less than 20. If I'm borrowing more than 20, the matter should be reported. Similarly, unencumbered term deposits to total deposits, ratio should be 10%. And if the ratio is less than 10%, the matter is to be reported. So out of the deposit received, 10% should be kept in term deposits, so that in case of any eventuality, this 10% can be given back. So I should maintain a minimum of 10%. If I'm maintaining 15%, it's a welcome sign. But if the ratio is less than 10%, the matter is to be reported. So examine the interest on deposits, repayment of deposits during the year, and report any default. So this requires again an examination of the register of the deposit holders. What is the total deposits held, and verify that with the figure in the financial statements, and the total amount of term deposits. And for the term deposits, obtain a certificate from a bank where the deposit has been held. And this deposit should be reflected in the financial statements on the asset side. Therefore, the job of an auditor is only about 4 or 5 steps. Number 1 is examine the deposit register, arrive at the total deposits, examine the term deposits held by the company with any bank, seek a third-party evidence or a independent evidence, then verify what is the own funds, net own funds compared with the ratio, and if there is any variation, report. It's a very simple reporting. Yeah, Ganesh to take over. Next. Ganesh.
Related party transactions. Section 167, 188, section 2 define what is a related party. See whether all the related party transactions compliance with section 177 and 188 of the Companies Act. You compare the related party transaction with the register maintained under the section 189 of the Companies Act. The audit committee resolutions, obtain written representation of the property. The transactions covered are all types of purchases, sale, purchase and supply of goods and material, taking loans, giving loans, selling of properties, leasing of properties, availing of any services. All these are covered under it. It is very elaborate. The related party transactions requires proper coverage, proper stress. Identification of related party also it should be done with utmost care. The process of identification will be told in the procedural aspect by Mr. Kali Prasad Garu. These are the related parties. I would define what are the various related party transactions that could go ahead, which could take place in a company. The procedural aspect will be covered later.
Ask the management to give a list of all the related parties. So they provide what are all the companies, the director of this company or a director in the other company. Or with the help of a DIN number, you can find out what are all the companies in which a particular director of this company is a director. So log on to the MCA website and find out. If I find that I am a director in company A, of which you are the auditor, you hit on my DIN number. That's not a difficult job to find out my DIN number. And what are all the companies in which I am a director will be known, and check if the company has got transactions with any other company in which I am a director. I might say that I am not a director in other companies, but then have a third party evidence. Independent audit evidence. Scrutinize all the transactions. Mind you, here it says all the transactions and not on a sample basis with the related parties. See that they are at an arm's length. Examine if they are complying with sections 177 and 188 and the details have been disclosed in the financial statement. So Ganesh has given you the reference of the accounting standard and also the auditing standard where you've got to give a reference to it and see that the same has been reported. Again, back to Ganesh. It's going to be about internal audit.
So the coverage of internal audit is whether it's adequate to the size and nature of business of the entity. It is an internal audit, as you know, it is applicable to all listed companies. And in case of private limited companies, it's applicable where the turnover exceeds turnover 200 crores or the outstanding from banks or financial institutions exceed 100 crores during the previous financial year. The internal audit plays the utmost importance for reporting for the auditor's report, because we rely on his report for so many internal controls, deficiency in internal controls and all. There is also a reporting requirement under SEBI's for listed companies and LODR regulations. It has to be the internal audit. We should see the nature of business, the coverage of internal audit, the scope of internal audit, and report. Come to a judgment order on this matter. In case of unlisted public companies, also it is applicable if the specified conditions are fulfilled. Then considering the observations of internal audit. Over and above the earlier reporting whether the internal audit is commensurate to the size and nature of business, we should not only say it is commensurate to the nature of business, we should confirm that we have considered the internal auditor's observations in his reports and framing our opinion. Care should be taken, because if the internal auditor is reporting on a fraud and we say there is no fraud on the company, or if the internal auditor reports on a continuing default in various internal controls which has an effect on bearing on their financial statements, we should make a corresponding qualification or a remark in our main report or report under this clause. We should properly document the internal audit report, obtain a copy of the internal audit report, including the draft internal audit reports, and document to them.
Company law provides that for certain of the companies, internal auditor need not be a chartered accountant. And for certain of the companies, internal auditor has to be a chartered accountant. I don't want to delve more into that because you people know about what are the companies where the internal auditor has to be a CA. In other companies, there could be an internal audit department itself, and it is run by the company. So number one is, in this background, scrutinize the internal audit system and decide if the system is commensurate with the nature and size of the company. This is again very much subjective. Obtain the list of internal controls applicable and their effectiveness. So discuss the matter with the internal auditor, the basis on which he feels it is acceptable. Scrutinize the procedures for internal control and internal audit, such as the internal control questionnaires or the flow charts or the analytical procedures which are adopted in the normal course, and to what extent we can rely upon the internal controls, and go on with the standard on internal control as to how do you decide the acceptability, the audit risk, and the reliability on the internal control system, where it is high or low or medium, and why it is high, why it is low, so on and so forth. Observe the comments made by the internal auditor and the reasons for such a adverse remark. Because in the normal course of audit also, apart from CARO also, when we rely upon the work of the internal auditor, we have got to discuss with the internal auditor. At the planning stage itself, we give a sort of a discussion with them and give them certain guidance as to what areas you would want him to cover more, because we are going to rely upon the work of the internal auditor to a certain extent, and we are entitled to rely upon that. So you carry out those procedures. and whether the reports of the internal auditors have been considered while formulating the audit report. This clause has been brought in CARO 2020. Normally, yes, we rely upon the work of the internal auditor, but we should say that I have relied upon the work of the internal auditor. And any adverse comments by the internal auditor have been carried to the audit report or not. So there could be certain variations. Like if at the internal audit level, he considered that to be material, but in your opinion and taking a macro view of the company, you may consider that to be not material enough to be carried to the audit report. You might have omitted it. That need not be. Any adverse comments made by them have been carried to the audit report. So you can just say that it has been carried to the audit report. All the material comments have been, which have been considered material, have been carried to the audit report.
Non-cash.
Yeah.
Section 192. Section 192 of Companies Act speaks about the risk, puts restriction on non-cash transactions involving directors. So no company shall enter into an arrangement with a director of a company, its holding, subsidiary or associate company, or any other person connected with him to acquire assets for consideration other than cash from the company. Okay. Whether or the company acquires the assets for consideration other than cash from such person, it has to be reported upon. So whether there have been any non-cash transactions, whether they are in compliance with the section 192. The essential part is the consideration should be received and it should be at arm's length price. There's one more.
Ganesh, you were saying something, you want to continue?
No, they're running short of time.
This non-cash transactions has been of, again, a recent audit in 2020. It was not there in earlier CARO. So Ganesh has given you certain examples of non-cash transactions. And here it is significant that both compliance and non-compliance has to be reported. If there are any non-cash transactions, whether they have been complied with the provisions of section 192 or not. In case of both, company has complying with that, say that they have complied with the requirements of 192. If it is not complied, say that they have not complied with 192. Yes, sir.
Whether a company is an NBFC, 45 IA of RBI Act 1934 requires an NBFC to be registered with the RBI and comply with the regulations of NBFC. No company which is an NBFC can carry on the business of non-banking financial activity, carry a non-banking financial activity unless it is registered with RBI and complies with the regulations of RBI. So what is a financial activity is a 50-50 case ratio. 50% of the income coming from financial assets or 50% of the assets and the 50% of the assets comply with financial assets, then it becomes an NBFC. If both the conditions 50-50 concept is satisfied, becomes an NBFC, mandating a requirement registration with the RBI. So the company should obtain the registration and then carry out the business of NBFC. If it is carrying on the business of NBFC or housing finance company without obtaining registration, it has to be reported upon. These two are complementary clauses. One is obtaining registration, then carrying on business, and whether it has carried on the business without obtaining registration. So if it is obtained registration, we have to give an affirmative report, and if it is not obtained registration but carries on NBFC activity, it has to be reported upon. Then the third reporting requirement is a core investment company. These all NBFC and core investment company are more defined under the RBI Act 1934. So we should go through the respective sections and rules made by RBI, rules and regulations or directions made by RBI with respect to these structures and see the compliance. So first we understand whether there is an investment activity, then go and see whether it is an NBFC activity, if it is required, whether registrations are applied, then whether it's a core investment company as defined under the core investment company directions 2016, and whether there's a compliance requirement on that. There are certain core investment companies which is for which no registration is required, the threshold limits of 100 crore or not met. Those things should be taken care. And if there are more than one core investment companies in the group, that also has to be reported on.
So number one would be registration under 45 of the RBI Act. So as Ganesh has explained, examine if it is necessary for the NBFC to be registered as a company under section 45 of the RBI Act. If required, obtain particulars of such registration and state whether the same have been complied with. Similarly, obtain a copy of the registration certificate. Ask the management to give you a representation about the registration. Obtain a certificate of registration. Once registered, there would be a compliance where certain quarterly reports have got to be submitted. See if they are complying with that or not. And coming to clause B, non-banking finance companies and housing finance companies, going by the nature of transactions, see if there have been any non-banking financial activities entered into by the company. In such a case, examine if registration has been obtained and whether they have obtained or not obtained. Both of the things have got to be reported. If they have obtained a registration, say that they have obtained a registration. If they are not obtained, say that they have not obtained the registration, though it is required. And if they are required to be registered but not registered, you bring it out. Then clauses C and D about the core investment company. Examine if the company is a CIC as per RBI. Whether the criteria of a CIC has been fulfilled or not. Having decided that it is a CIC, examine if it is exempted from registration or if it is an unregistered CIC which has to be reported. There could be more than one CIC within the same group. The number of CIC within the group to be reported. There could be 4 companies. You mentioned that there are 4 companies, company name and the SIN of the company and the place where it is registered. So bring out very clearly about the investment activities if there is more than one CIC within the same group.
Cash losses. Whether the company has incurred cash losses in the year or the immediately preceding year. If so, state the amount of cash losses. What is cash loss? Cash loss has not been defined anywhere in the Act, but it has to be arrived upon. We are very well aware that by adding the profit and loss after tax, depreciation and impairment losses, which are non-cash items, and other non-cash charges, we can arrive at what is the cash profit or loss. If there is a cash loss, it has to be reported and quantified. And along with that, we should also state whether there is a cash loss in the year under review and in the immediately preceding previous year. Both needs to be reported. This was a reporting requirement earlier under the CARO and other things with the SICA going away, SIC companies act going away. This lost its importance. It has been brought in to complement with the other reporting requirements here under the CARO, which will be discussed in the next upcoming process.
So again, take recourse to cash flow statement. In cash flow statement, we have got one cash flows from operating activities. If it is negative, it is clean case of a cash loss. And that will give you, and also examine the same cash flow for the year before the audit, so that for 2 years, mention year-wise cash losses. So you make a small table, which is the year, current year, previous year. We are commencing from, say, financial year 21-22. So 21-22 will be the current year, 2021 will be the previous year, and the total cash loss. This is a requirement to be mentioned in the Act.
Resignation of the statutory auditor. Resignation of the statutory auditor. Under the Companies Act 2013, the tenure of appointment of a statutory auditor is 5 years. He continues to be an auditor for 5 years, and so there is no question of reappointment or confirmation in the every annual general body meeting. In the earlier provisions of the Companies Act 1956, the auditor retires at the end of the every AGM and gets reappointment at each and every AGM. Now, if once appointed, he continues to be an auditor for 5 years. If there is a resignation, such resignation has to be reported upon. Not only the resignation, the causes of resignation, any, and concerns raised by the resigning auditor has to be reported. The auditor could have taken note of a fraud and resigned as such. So it should be covered under the earlier reporting requirement of fraud. He would have raised a issue and submitted an ADT 4 to the NCA. That has to be considered, and causes raising to his resignation and objections raised by him has to be reported upon under this clause.
So this clause has been introduced only in, again, the latest CARO. And one is when we take over as auditor of a company from another colleague of ours. It is the professional ethics which require that we communicate with him before you accept it. There, in majority of the cases, the members do not bother to respond. But I think it is good that they respond so that it will be helpful for the incoming auditor for the purposes as to why he has resigned. So where the previous auditor has resigned, normally they simply say that due to personal reasons or due to overload of work, due to ill health. So all these are very common, but the real fact may be different. So discuss with the auditor, talk to him, because he is after all our professional colleague, discuss with him as to why did you resign. So they will tell you. So you consider, if you are appointed as an auditor before the expiry of his term. Now resignation is different and retirement is different. If his term of 5 years is over and doesn't want to be continuing, it's a different case. But within a period of 5 years, if he is resigning, there should be something very serious as to why he wants to be resigning as auditor of the company. So examine 83 file, and this is what is normally taken as a procedure, but I really don't give much credential to this, because what is stated in 83 does not really satisfy me as an incoming auditor. There could be a reason which is not mentioned in 83. Why he has resigned, you should know. You should know the reasons, issues, and mention whether the same has been considered. But normally what happens? Now this is the procedure, but I'll give you the practice also. Ganesh resigns as auditor of a company. In 83, he simply says that I'm resigning of the company because it is exceeding my limit, or I'm resigning this company because my health doesn't permit, or I'm resigning this company because I've taken some other assignments, or I'm studying something else. All these are only on the face of the paper. The reality comes to know only if you discuss with them. So you consider, now the CARO does not say that, it should only go by 83. Discuss with him, try to get as much information as possible, and then report that. whether you have considered. Now you don't have to mention the reports, only if you have considered the points raised by him or not. So simply say that all the reasons raised by him for resignation have been considered by me. That's all. But don't say that why he has resigned. That will be again violating not only this, you will be violating also your code of ethics. Don't do that. Don't mention the reason why he has resigned. If you were good enough to give the reason, you have put it in 83 itself. The very fact that he's not putting it in 83 and he's only telling you personally, it means that he doesn't want that to be reported anywhere because that acts against the interest of the company and against the interest of the auditor. Don't get into these kind of difficulties. Take 83, give a comment saying that all the reasons, issues, and other aspects as revealed by the outgoing audit have been considered by me while accepting this assignment. Don't go beyond that. Yeah, Ganesh.
Going concern. The financial statements are always based on the assumptions. First of all, I think one of the basic assumptions of preparation of financial statements is going concern. Now we have to go beyond the basic assumption and confirm that the company is a going concern. So whether it will override the basic accounting assumption or whether it come to a question where it contradicts the basic accounting assumption under which the financial statements are prepared is to be decided professionally. And if there is a going concern question being addressed here, that we tell that there is a company ceases to be a going concern, the methodology of preparation of financial statements, basic assumption of preparation of financial statements needs to be revisited. So it is telling that on the basis of financial ratios, the aging and expected risks of realization of financial assets and other information accompanying the financial statements, that whether the auditor is of the opinion that the going concern may not be, the basic assumption of going concern is not correct. So this is a self-explanatory, very elaborate question given under CARO. There are the financial ratios are being disclosed under Schedule 3 of Companies Act as a mandatory disclosure requirement for all the companies. There are specific ratios to be disclosed, which should be considered when forming this opinion. Over and above the ratios, we should discuss with the board of directors their management plans and obtain a management presentation letter that the going concern is not vitiated and there is no problem of preparation of financial statements under going concern method.
I have unmuted.
Yeah. Going concern is one of the basic fundamental assumptions for any accounting financial statement. So we should be sure that it continues to be a going concern. Once there was an issue, whether a company against which CARP has been initiated can continue as a going concern. And the NCLT has given orders, and in the order also they mentioned that you wind up the company, you sell the assets of a company as a going concern. So should I take that as a basis for me to decide that it is a going concern? That is for you to ponder about. When it comes to CARO, it says that the revised schedule 3 says that we should give financial ratios. I feel when you're giving financial ratios, you should also give what did you consider by the financial ratio, what is the numerator and what is the denominator. So you have got to do certain analytical procedures over and above what were taught to you, what you were doing all these years. Calculate the financial ratios. All these years for the company audit, we were not calculating financial ratios. Only for tax audit, we have to give certain ratios and be done with it. But here, in the revised schedule 3, you've got to give the financial ratios and the aging analysis. So you should see whether they are in line with the industry norms or not. Expected dates of realization of fixed assets and the due dates of meeting the liabilities. Now, when you are doing this, you should be in a position to see that whether the company is in the position to realize the assets and pay off the liabilities. Where the current ratio is less than 2, where the current ratio is only say 0.5, and there is some liability coming up, whether the company is in a position to meet the current liability or not. So consider this in the light of management plans for the board of directors and draw a conclusion. If any material uncertainty exists about the capacity of the company to meet its liabilities existing as on the date of balance sheet, and when they fall due within a period of 1 year from the balance sheet date. And in the last few years, we have got to consider the coming year's liability to repay the loans. Though it is a long-term loan, the liability to repay the loan coming in the coming 1 year should be taken as a current liability. Whether the company is in a position to meet any current liability as in when they fall due within a period of 1 year from the date of the balance sheet. So as on the balance sheet, I am giving my 1 year's future EMI as a current liability. Now my liability to pay comes on every month on a month-to-month basis. I don't have to consider all the 12 months at a time. And going by these analysis, if you find that the going concern status is endangered, please report it. Please report it. But before saying that it ceases to be a going concern, discuss with the management, obtain a management's perception regarding the meeting of the commitments on due dates, together with the reasons therefore, document the same, and draw a conclusion to justify their perceptions, whether they are having a valid reason or not. If you are satisfied, say that the company is in a position to meet the liabilities. If not, report that they are not in a position to do that, so the going concern status is in danger. Yeah, Ganesh.
Coming to the going concern, I would like to add for current maturities of long-term debt will not be considered as a part of current liabilities for calculation of current ratio. This has been clearly stated in the guidance. The next and the last penultimate clause is the CSR. The CSR reporting requirement has changed for the financial year 2021 itself, wherein elaborate disclosure has to be given about what are the ongoing projects, whether the money has been deployed, and whether there is a requirement on section 135 that the money, unused money, has to be kept in a specified special account pending utilization. This has to be confirmed by the auditor. This was the part of the director's report, the CSR reporting. Now it has become the eternal part of our CARO report. So if there is any unspent money, it has to be kept in a separate account, and any pending projects, it has to be deposited in a specified account within 6 months. So we go through the sections of 135, 198 of Companies Act. Schedule 7 of Companies Act 2013 tells where the money has to be, what are CSR activities and what are the activities which can be considered as CSR activities. These to be considered and reported upon.
CSR is relatively a recent origin, and promptly CARO has brought it into its ambit. But 2016 itself, CSR was there. I really am surprised that this was not brought into CARO 2016. Anyways, we should seek a confirmation from the management that the unspent funds of CSR funds have been transferred to fund within a period of expiry of 6 months from the financial year. Study the transactions and obtain the certificate from the bank, so that should be kept deposited in a separate bank account, and the money should not be touched upon by the company except for the purpose of carrying out this activity. Here, I find that there is a difficulty. That my audit report is within a period of 6 months. In case of a listed company, we sign our audit reports in the month of May itself. But the company has got time till September to deposit the money. So the company would say that I deposit within a period of 6 months and there is no big hurry. Issue a proper disclaimer in this clause. State very clearly that the company has got time till expiry of 6 months and the company has represented to us. So take a letter from them, say that the company has represented to me that they will deposit the money before the due date. Be clear of it. Don't unnecessarily say, yes, I am very sure they are going to deposit the money. Don't give any such assurances on behalf of the company. Yeah. So the last clause, Ganesh will take over.
The last clause of CARO is the consolidated financial statements. This is the only clause to be reported in case of a consolidated financial statement. In case of a consolidated financial statement, there is no CARO reporting requirement. Now this reporting requirement has triggered. We have to tell that in framing the report, in the CARO report, we have to only state that what are the clauses of subsidiaries where the component auditors of the subsidiaries have given reservations or qualifications. We have to mention the company's name and the process where there have been qualifications or reservations expressed by the component auditor. We need not reproduce all the component auditors report, components of the auditors reports qualifications. We just mention the process. For example, if it is 320, the company has not spent. In case of subsidiary A, the component auditors reported that the clause 320, the CSR has not been complied with. That has to be reported, and that will do with our reporting requirements in case of consolidated financial statements. This clause is not applicable for standalone financial statements. It is only applicable for consolidated financial statements.
Earlier, there is no specific requirement for auditor to comment on the consolidated financial statements. Now, the auditor has got to mention whether the comments made by the auditors of the components, subsidiary companies, etc., have been considered or not, number one. Number two, in case of any adverse reports of the auditor of a component, mention the reasons for such a qualification on a case-to-case basis. If the auditor is unable to form an opinion, issue a disclaimer explaining the circumstances under which he is unable to form an opinion. There could be a possibility that at the component level it may be material, but at the consolidated financial statements the materiality might change. So wherever there is an adverse comment passed by any of the auditor of a component, consider those comments, and it is not necessary for you to reproduce the comment of the auditor of a component. Just mention whatever adverse comments made. So there are 3 sentences which you got to mention. Number one, we have considered the audit reports of the components of the consolidated financial statements. Number two, there were no adverse comments passed by any of the auditors of the components if there are no other things. So except the following, there were no adverse comments in case there is any adversity. And if there is any adversity, you mention auditor of company so and so has issued a query or issued a disclaimer or made a reservation on this particular aspect. And if you are not able to form any opinion, say that I am not able to form an opinion due to various reasons, and also mention the reasons, the circumstances under which you are unable to form an opinion. So, ladies and gentlemen, that's it. So we have come to the end of the session. It has been very useful, and we open the session to any of the participants for their questions, and we'll be able to answer them.
Yes, sir. I will share my screen from you. Is my screen visible to you, sir?
No. We are getting a blank screen.
One second. I will share it again.
Please.
Is my screen visible right now, sir?
No, I'm able to see Naresh. Hi Naresh, how are you?
Is 3-year periodicity of verification of fixed assets recommendation of the institute or standard? It is a recommendation of the institute. It's accepted now.
Sir, good evening, sir.
Is my screen visible right now, sir?
Not visible to me, but Naresh is able to see.
Is 3-year periodicity verification of assets as per law guideline of the institute. It's a guideline of the institute. Depending on the nature and size of the business, it should be completed within 3 years. All the assets should be covered within 3 years. For clause 3(7)(a), whether the income tax and excess where companies expect extra tax rewards with some of the reporting requirement for the see the Vivad Vishwas scheme or Sabka Vishwas Sabka Saath schemes have closed in the financial year 2021 itself. So I don't think there will be a trigger of requirement in 21-22. Clause 3(9)(e) and F, the companies borrowed 2 years ago and given responsibility. Clause 3(9)(3)(e) and F. 1 minute. See, 3(9)(f) says that whether a company has raised loans during the year for the pledge of securities held by in its subsidiaries, joint ventures, associates, so give details here. And the requirement is there is a default. 9 doesn't talk about default. It is only during the year if I see. In opinions, what's the opinion? 3(9) and F. Loans and other defaults.
3(9)(e) and F. If the amount is borrowed 2 years ago and given to subsidiary to be reported, yes.
Yes, sir. It is only.
You're still carrying it in the balance sheet.
No, it is current year only. 9 and F say only about the current year.
It is carried to the balance sheet. It is still there.
Still, it is not during the year. The clause says it is during the year.
What does the clause say? Doesn't say within during the year. In my opinion, if the company has got borrowings, they have to be reported.
See, the clause 3.9 F says that the company has raised loans during the year or pledge of securities held in its subsidiaries, joint ventures and associate companies. If so, give details thereof and also report the company has defaulted on repayment of loans, such loans raised. So there's the default we have to report
Yeah.
and not in case of regular borrowing. And 3.9 talks of the company has taken any loans from any entity or person to meet the obligation of its subsidies and joint ventures. If so, give details and nature of such transactions in such case.
That
So
should be reported, even if
doesn't
it's
say anywhere. 3.9 could be is a different clause. It is talking about the loans taken to meet the obligation of subsidies and associates. Here talks about the loans taken during the year. So the stress is on loan taken during the year, and I don't think they will be reporting the problem.
That is for F. E, there is a requirement.
E, there could be a problem.
There is requirement under 3E, 3.9E, and not required under 3.9F.
Holding company giving corporate guarantee to holding on subsidiary, irrespective of it's a contingent liability because it's a
It should be reported.
It should be reported. Whether adverse comments given by internal auditor should be carried on to the audit report is a case of evaluation of case of materiality. We should see the materiality. What is the adverse comment?
Now, one moment. It does not say that it should be carried to the audit report. No. You have got to decide whether you should take it to the audit report or not. We should only consider any adverse comments made by the internal auditor has been considered, and if you feel that it is good enough to be taken to the audit report, you take it, not otherwise. It is on a case-to-case basis. It is not a blanket rule.
Here, materiality should be applied.
Materiality should be applied, yes.
Because if there is any materiality and does an impact on the future performance of the company, and if you are not reported, it will have an impact.
And I like this question number 6. If a subsidiary has not completed its audit and audit report not available on the date of finalizing the holding company's balance sheet, what is to be reported? Report the same thing. Say that the so-and-so company has not yet completed their balance sheet and is not available for comment. And if foreign subsidiary companies are exempted from audit, how to report in CFS? They're going to give the returns. They are exempted from audit, but they have got to give the documents required for the purposes of the audit. So as such, they are exempted. Foreign subsidiary are exempted, but they've got to send the annual returns, and you consider those things and mention in 21.
Remove the screen. Question 8. There is no question 8.
Only 7. We are not seeing beyond question 7.
Yes, sir. Those are questions, sir.
That's all.
Sir.
Nice.
Right.
Over to Nari, sir.
I think 7 were the questions being asked by the members. Yeah.
Naresh, your audio is not visible, sir.
Yes, sir. You're muting yourself, sir. Actually,
On
unmute
this
yourself.
topic of CARO
Yes, now it's good.
2020 and provisions and procedures. So I'm sure both the speakers, Ganesh it.
Sir, your audio is coming and going. It's breaking.
Am I audible now?
Yes,
I'm
sir, you are
audible.
audible.
Now it's better. Gone again.
Yeah. I think for all the members who have joined in for this session on CARO 2020 provision procedures, I'm sure our speakers from Hyderabad, CA Ganesh and CA Kali Prasad Garu would have explained and taken you with all the in depth of the provisions of CARO. As okay, I think some technical signal problem, sir. So I would like to thank
You can go.
Thank you so much, sir. Thank you so much.
Monica Ganea, Nadesh is not audible.
Just like left this session because there's some technical error from his end, sir, actually.
Okay, fine.
So thank you so much for your time, sir. Ganesh, thank you so much for your time also, sir. So we'll end the session, sir.
Okay, fine. Leave.